So yeah, we covered a lot of different topics, across the markets and macro environment. And I think maybe one of the best launching off points for this audience in particular, and we can take it any direction. I think we have a number of topics, and if there's anything anybody here wants to talk about, but one of those maybe most relevant would be stable coins, and given the likelihood that the Genius Bill is going to pass, the effect that has on the demand for U.S. debt, and how that might be a relief mechanism for the upcoming issuance burdens that we've been talking about today, resulting from the deficits. And maybe just a question to pose to the audience and everybody here is like, basically owning a stablecoin in the U.S. Currently your alternative is dollars at a bank account where you might earn a T-bill money market where you might earn 3-4% return on that, or you could own a stablecoin as this decentralized dollar that maybe is out of the jurisdiction, but you don't get paid interest under the Genius Bill, and so basically you're suffering from deterioration in your real purchasing power by not keeping up with the rate of inflation, and so allowing stablecoins to permeate through the system and grow, is it really, we were talking about a kind of almost like a vampire attack on like capital flows in other countries by being the first to market with a digital currency, and generally, the U.S.'s position is not too deteriorated yet. There's still demand for dollars on a relative basis, and so you're basically like going into these foreign countries and proliferating our currency and trying to circumvent, their government capital controls and provide people access, and in a way that does open up demand that wasn't there already. But would be curious if people have any thoughts on stablecoins and what that means, and if any kind of strings to pull on there.
So stablecoins can make it a lot easier for regular people in a lot of these countries to have a dollar-based position, right? One of the big use cases of even Bitcoin is that it is effectively a US dollar denominated asset, and you don't have access to stocks, you don't have access to T-bills. That's the best store of value you can get, like even ignoring like all the hard money stuff that we all probably think about. I don't know actually if the stablecoin bill will actually increase the net demand for US treasuries in these economies, because in a lot of ways, the constraint in a lot of the countries where there is a pressing need for dollars and they're pro-dollarization is actually the inflow of dollars into that country. And if you look at a country like Nigeria, a lot of times the constraint is how much dollar liquidity do the market makers have. It has nothing to do with the demand. The demand is almost always there. And where you make your money from is the folks sending from the United States to these countries. Whereas in those countries, it's super competitive to get the lowest rate possible, because the demand's already there. Like stablecoins are just competing with duffel bags of cash. So I guess my perspective is I'm not really sure if it'll actually change that much in the demand side. Although it may make it a lot easier to like move into USD cash and through wire transfers, and that was Bridge's big thing.
Okay, I'm going to throw a hot take out there in the mix just to get people chatting. But something I've been thinking about is, okay, we're in this situation, we talked a bit about on the pod, but we're in the situation where we have a significant current account deficit in the US and a significant capital account surplus. And the mechanics of that is how US dollars get to the rest of the world. Stuff comes into the US, dollar-based assets go to the rest of the world. If we follow the logical continuations of taking the assumption of what the current Trump administration wants to do, which is to narrow that deficit, they've attempted that through tariffs to narrow the current account deficit. But my thought process is, well, if they go towards the capital account surplus and institute capital controls or some form or another, such as taxing remittances, foreign withholding taxes, that is another way to narrow that trade deficit by going after the capital account surplus side of things. And what happens when that occurs is that less dollars will get out to the rest of the world. Now, that's an interesting situation when so much of the world either needs dollars or prefers dollars as a store of value, as opposed to their emerging market currencies, et cetera. So how do we get US dollars to the rest of the world in this regime where the trade deficit narrows? starting to think about stablecoins as a method to circumvent getting US dollar access to the rest of the world in a world where we're seeing less dollars going out to the rest of the world because less stuff is coming into the US. So that to me is something I don't have a fully fleshed out view on this, but it's something I'm thinking about, that in the future, if this were to occur, perhaps stablecoins are the methodology to get those dollars to the rest of the world in a regime where we have a more narrow trade deficit. Curious if anybody's thoughts.
Basically, domestic economic activity in those countries will be dollar denominated, because you effectively, what's going to happen is if you start to tax foreign income on U.S. assets, right, that naturally reduces, to your point, it reduces the amount of dollar but then, like, you're basically potentially upsetting the domestic equilibrium of those economies, because then it's like a Venezuela situation, right, where instead of transacting in the bolivar, people just prefer to transact in the dollar, and that strengthens the dollar relative to those currencies, because it probably compound. I mean, it seems like it could do that, but it also has the effect of like destabilizing those local currencies, especially in governments where maybe like the economic situation is very precarious.
Yeah, I think it could increase dollar dominance. It looked like you wanted this or something.
Yeah, I was going to say, I mean, this is already happening. Somebody posted a picture on X the other day of a shop in Bolivia where the prices were in USDT. So as long as there's a payment mechanism that allows people to actually spend stable coins easily, it could be a big source of demand for US dollars. My question is, for treasury assets purchased and held by stablecoin issuers, my question is how the Genius Act is going to affect that. Do you think it's going to enable stablecoins to be adopted elsewhere, or is it going to restrict who gets to issue stablecoins?
Yeah, it from my understanding is that it basically helps them control who's able to do that and who's able to access the access to the treasury market, and also presumably some just like money market funds liquidity profile that needs to be met, which is like kind of 3 or 6 months and less. So there's no breaking of the buck risk and duration mismatch. So yeah, they definitely will be able to control. The thing is, it's funny because it's like on the one hand they want to control who has access, and for years Circle and Tether haven't been able to access the Fed directly and going through bank accounts that makes no sense and introducing all these counterparty risks. But then on the other hand, kind of the only real bull case for stablecoins in terms of new treasury demand is stuff that is quasi outside of the system today. Like if you have access to the system, you don't necessarily need them. They're much more efficient, cheaper, lower cost, quicker, 24/7. There's all those benefits, but those aren't the benefits that bring on new supply or new demand for treasuries. The new demand must come from, and I think to your point too, you still have the on-ramping potential hiccup there, because like if you look at the Nigerian problem, that's basically what it is like getting the currency into the dollars. And same thing, like I guess this would be done internationally through crypto exchanges. And if you look at a lot of these countries, like most countries, they all have some sort of capital controls on funds that can go from bank accounts to crypto exchanges. So yeah, I think the growth numbers is probably optimistic from the administration, but the trend is definitely up.
So I feel like one piece that comes with Genius is, so stablecoin issuers are, I'm forgetting the exact numbers and I don't want to give the wrong data, but it's something like the 12th or the 7th like largest holder, like Tether and Circle, the 7th largest holder combined of US T-bills, which is wild. And so part of Genius is really focused on, okay, these are largely offshore or not perfectly like fit for purpose regulated entities. And so a large purpose of Genius is to provide clarity and certainty and regulation for those entities. I think that paired with that, when we think about even what Treasury themselves predicts is going to be coming with stablecoins, I think Treasury recently put out a report that said that they're expecting trillions, I think 5 trillion in the stablecoins over the next couple of years. So Treasury thinks it's going to be a significant source of maybe not buying demand, but that it's going to grow. I mean, right now it's at like hundreds of billions. They're expecting it to grow to multiple trillions.
I mean, I think for me, what's interesting is that you had brought up in your session the lack of safe haven funding, safe haven flows we're seeing into the US dollar market, into the US Treasury market. But it's telling to me that right now we are seeing a boom in stablecoins. So to what extent is the lack of safe haven flows we're seeing traditional US dollars being taken up into the stablecoin market instead, especially the foreign flows, right? Which actually, and to your point, I think this whole question of flows from accounting perspectives, right? So trade deficit is related to the capital outflows. I think there's a really sort of geeky, wonky accounting question as to how these stablecoin flows get counted in the data, right? So Tether buys treasuries, possibly through a US bank, but possibly not, which is a capital outflow, and then it sends those to a different country, but they only perhaps need to do net settlement as opposed to like full value settlement. So I think there's a lot of nuanced accounting questions as to how these stablecoin flows even show up in the capital accounts.
Well, and I feel like to that point, as we think about Genius, and I mean, well, I won't specifically out them, but there is a lobbyist who worked on Genius in the room. And one of the things, my understanding is, as we think about, Tether and some of the things that went into Genius and some of the pieces that were added towards the end it was around, wait a second, Tether is this like Cayman Islands registered business. If they can just send USDT easily to Americans, then like why would anyone ever set up shop in the United States, be subject to all these controls when you can just go set up in the Caymans and just do a loop and then the controls have no effect. And so I think as Genius sets stricter guardrails around what is a stable coin, how to define it, things like that, to Gina's accounting point, we'll have more rigorous understanding of, okay, well, these are like Tether. I think like Tether was talking about issuing a like new stablecoin that is compliant with Genius, that's separate from and so that will help, I think, with the flows as we're able to differentiate between kind of regulated, compliant with Genius stables versus kind of what we're seeing today.
One question I have just on the Genius Act, to be honest, I didn't fully read the bill or anything like that, so I don't pretend to have any expertise, but my understanding is one of the key components is that they will force that these stablecoins will not be interest-bearing, and to me that just seems like a very precipitous situation and a slippery slope, because effectively by doing that, you're ensuring that the money that's in money market funds remains in money market funds, because why would you ever take your money out of a money market fund that's earning 4.5% and put it into USDT when it's just Circle keeping that yield instead? So it feels like a bit of a shame to make that so absolute that you're basically cutting off what is one of the most interesting addressable markets for me of stablecoins, and ensuring the fact that, as opposed to encouraging money market funds to take up what seems like a pretty interesting technological breakthrough, which is stablecoins, and making the existing money market funds 2.0 on digital rails, we're instead just saying, hey, you can't have interest-bearing stablecoins, and we're only going to keep that for Fidelity.
I think the other funny elephant in the room is that by blessing, and saying, okay, Tether, come on into the U.S. with this regulated version, the U.S. also isn't going to say, hey, oh, by the way, you gotta sell all those 250 billion or whatever you got of treasuries in your non-regulated version. Like, the elephant in the room is that they kind of need them to be that buyer internationally, and it's kind of like, all right, we're just not going to look over there. And if people even knew the origins of like Tether's original setup and infrastructure, they would probably even be more, question. Like, I mean, Tether, it literally started as like individuals scattered around the world that had bank account access with billions of dollars flowing through. and registered in individuals' names to get, because they couldn't have access to bank accounts from any legitimate means to purchase the assets that they held in. So it's there's a lot of, speaking out of both sides of the mouth from the U.S. government here, because on the one hand it's like the Oprah meme. Everybody, you get a stable coin because it's like, please, we need someone to buy our debt, but also trying to do it in a way that doesn't completely restrict every potential new avenue and finance like terrorism or something.
The really interesting outcome of this is that also it's a tacit endorsement of Bitcoin, because what is Tether doing with 25% of their net operating profits? They're buying Bitcoin with it, right? And so we're thinking about, we're talking about these treasury vehicles on MicroStrategy having this like this premium to NAV and using it to buy more Bitcoin. Well, Tether's Bitcoin holdings have over the last year steadily grown to 100,000 Bitcoins, or about $10 billion over this period, right? And that's probably going to continue to grow. So it's like, if you tie those at the hip and you don't rebate the interest and make it competitive so that stablecoin issuers have to give back the interest, that actually might down the road have serious implications, because dollar dominance actually then becomes irrevocably tied to Bitcoin dominance under the existing model.
I think what it kind of points out to me is that almost anybody can issue dollar debt now, and where we draw those controls is going to be the defining factor of the dollar as we go forward. Could you go down that failure modal as you understand it if the U.S. does start to take opinions as to Tether's moneyness, maybe go down that path and how that might look?
So I guess is it 150 or 200, like the Tether outstanding supply, maybe 170? Yeah, 165. I mean, the government, no, I've been of the belief for a long time, and maybe someone else believes differently, but that the reason Tether exists and has grown to the size it is because the government knows everything about it and inside and out. And anytime Tether's many times blacklisted wallets, shut down, restricted people's movements. So the funny thing to me about this whole Tether Circle USDC USDT battle is that Circle's lost has lost the game and market share, despite touting themselves as the regulated, open, all this stuff. Meanwhile, behind the scenes, Tether's grown because they, on the surface, reject that, but in reality are doing the exact same information share, data share, et cetera, because the U.S. government could easily have shut it down 1,000,000 times over by now and just made it worthless by confiscating the assets. So to me, the fact that they haven't done it already is like, they're just never going to do it. I think that chance is very small, but you never know when power changes and it's not, the Trump family piggy bank. But yeah, but again, anybody in the Treasury would be like, okay, a fire sale I think you would just confiscate it, because if you, the case would be so draconian you'd confiscate it, so there's no selling effect of the 170 billion on the market, where it's just like, okay, basically those are our assets now and that debt's retired. And sorry to all you foreigners who held money thinking it was good, and also 60% of it's Chinese holders, or like some geopolitical rivalry, even better, because we just attacked you in a way, because they would never want a situation where they just fire sale 170 billion of T-bills. So
could they just not redeem, or is that kind of a...
Well, at the Tether level, yeah.
I think for me the interesting question is if Tether fire sales, it's because people are leaving the US dollar. But the flip side is, where do those people go, right? Because if I'm a big bank and I used to hold stablecoin,
Yes.
well, and maybe now instead of holding Tether, I now hold US Treasuries, right? If that happens 100%, all those Treasuries it's a matter of whose name is on the account. Right, that's a really interesting stabilization mechanism within the treasury market of stablecoins. If it's a bunch of big institutions dropping the stablecoin and they just turn around and buy treasuries, there's no overall effect in the treasury market. I do think that there's a subtle point that you picked up with the Genius Act not charging an interest rate. I don't know how many people realize why that is. It's essentially because there's a concern about what's called banking sector disintermediation, where people, instead of putting their money in banks, put their money in stablecoins. Now, who cares about banks? The reason that there's a concern about that is that people go to banks to get loans, right? So you want to start up a business, right? You go there to get the loans. And so if you have fewer people putting savings in banks, you also have fewer loans available in the economy. So that's the reason why you've got that no allowance, no interest rate.
The narrow banking argument, where
I don't know exactly what you mean by that, so I'm not going to answer that question. But I have a slightly different point here, which is that, so Genius Act passed, stablecoins become, more proliferate everywhere. That doesn't, by design, is supposed to not have a massive impact on the US banking sector. It does have an impact on all of these other countries where people are now holding their savings in stablecoins instead of in their local banking sector, which can decrease their productivity growth and their economic growth because they are now starved of these funds. And I don't know to what extent that kind of lending behavior has ever been picked up by the crypto market. Like, if I want to buy a house, can I get my mortgage funds from the crypto market as easily as I can from the local bank, right? So is there going to be damage done in that kind of knock-on effect from stablecoins?
I feel like it's a really interesting point to highlight. And I think even within the Genius debate, when it was coming to the floor, we saw this playing out, and it's a really excellent point. So ICBA, which is the Community Bankers Association, so these are smaller community banks, your local branch, your local farm credit, right? So they do loans for like your local farmers. These are less, hundreds of millions in assets instead of these huge, large, global banks. And so one thing that we saw before the cloture vote on Genius was that ICBA flew in dozens, if not hundreds, of their local bankers to go talk to their member to say, you have to vote against Genius. And it was exactly for the reason that Gina raised, which is that these community bankers are realizing, wait, if people can get yield on stables, and they're going to start looking at having dollars on their phone instead of having dollars in the local farm credit, why do we exist? And the real thing that they end up continuing to hang their hat on is like a geographic monopoly, right? That's one of the only things that they have, right? So they're a local community bank. They have to have an office branch open. They have to do, probably checks still, right? They have a lot of physical costs that come with their business that stablecoins don't have to pay. And so they lobbied really, really hard against Genius. Ultimately, weren't successful, but it was a really big hiccup in cloture. And I think surprising for a lot of people in the industry when it happened. But I think it's a great point, and I think if we're seeing it in the U.S., we're going to see it abroad. Because I feel like
it doesn't pay interest in U.S. dollars, but if your economy runs on a foreign currency, you're going to get some implicit potentially gains there, right?
Yeah, because if you're in Turkey, right, if you had access to a US dollar stablecoin over the past 5 years, you've accrued purchasing power, right, in local currency terms just simply by holding the stablecoin, even if it is non-interest bearing. And I think the really interesting thing is that you're seeing, others are looking at this opportunity and recognizing the ability to disintermediate banking. It's not necessarily just crypto native people. Stripe made two very purposeful acquisitions, right? They bought Bridge and they bought Privy. And I think the idea behind that is they want to enable stablecoin usage. They don't really care which stablecoin it is, but if you're able to just keep the dollars within the Stripe ecosystem and not move them into a bank, that disintermediates bank and strengthens the Stripe moat. And so that I think like you're starting to see this happen, and then community banks, we're already losing market share relative to the larger national banks like JP Morgan Chase because they don't have a technology front end, they don't have distribution, right? They were already struggling because, and you could look at some of these banks because a few years ago there was an investigation into like how are community banks making money. Well, a fair number of them were doing things like providing like financing aircraft leases to Russian oligarchs, right? So there was already this reach where they were struggling to find alternate sources of the business, and they realized the time is ticking. So I think that like the sea change is going to be inevitable because these institutions have largely served their purpose, which is back in the 1940s, if you were a farmer in the Midwest and you need access to financing, that's what the institution was for, right? But we don't need that anymore, and it's just they exist as a function of natural
we
inertia.
still need we still need liquidity for farmers, right?
You
We
still
don't
need
want
liquidity for
American
farmers.
farmers just like blowing up left and right. And I think that actually Gina raised a really great point on this too, where it's like, okay, so is Aave doing farm loans now? Like I haven't seen it.
Well, but there is I think we're starting to move in that direction because you've started to have startup like 3chain come out and say, well, we're basically going to start issuing under collateralized loans on chain with KYC, right, in off chain. And the idea is like, well, like if you do default on that on chain loan, we can utilize the off chain traditional finance rails to actually enforce our ownership claim. And so I think that's the start of potentially the space moving in that direction, because functionally, if you could get a stablecoin loan on like via Stripe, right, and it just runs your credit check and issue the loan the same day, why would you go to the community bank?
Yeah, just a brief data point on that. We have a bank account for the fund that we can receive. We have a USDC. We can receive stablecoins. The company's Meow. They're a fintech like neobank. You can receive stablecoins. It comes straight to your bank account, swap it immediately to treasuries, earn yield, and then send out stablecoins. So receive dollars like a wire. It's like that's where we're headed. And then how also on top of that, then how the duration of those deposits, which we saw in the March banking crisis of 23, for the first time ever, a bank run could happen overnight from everybody's smartphone instead of there was a physical prevention of bank runs, meaning you had to line up and people are working 9 to 5. I can't get there. Now you can have a bank run on instantly, and that's another risk. Same with removing the financing, that there's so many things. So they really probably should walk it slower, or not slower than they are, but it's probably prudent to not go full bore instantly because of the disruption it could cause.
I think is interesting, though, is actually the exclusion of yield from the going to the end user might have the implication of actually speeding up adoption of DeFi and lending of stablecoins. And I mean, DeFi had a lot of problems in terms of user experience and whatnot, but like I think it opens up the opportunity for creating a DeFi mullet, easy on-ramp access that like would completely eliminate these banks, regardless of their lobbying.
Would that require people, though, to tokenize their farms and their houses so that they can use them as collateral?
I was talking to someone last night who was trying to do that, and he's here.
I mean, that sounds really cool, but there is a practical, like, how long is that going to take, right?
Well, it's going to be motivated by the yield. So if you take away the treasury yields, you're going to get a lot of innovation. And if somebody says, hey, I can give you 7% over here if you pick up these mortgages, then I think it'll happen relatively quickly because people are going to move to where the money is. And they're going to want to be able to get yield somewhere. So I think it'll drive innovation. And, it may not be the banks that actually do it. They may be the losers in the game unless they're thinking about it clearly.
I think that's exactly it. Like, again, it's distance from issuance. And because if you can't control that, you have these proxy dollars floating around that are competing with the dollar better.
And just to add, the tokenization of real world assets, including like loan, for example, or even factoring, is happening very quickly. RWA is a conversation this year, and there's a lot of startups who are building these standards and also these experimental, I would say, early prototypes to tokenize this type of assets. I think they're probably like a cycle or two away before we essentially remove the need for these like regional banks.
Is there a chance that Genius just screws over Americans?
Yes.
What a tough question. I mean, I think as someone who spent some time working on it, not specifically Genius, but working on stablecoins and market structure, and I worked in Congress before coming to Confusion Capital. I mean, as I think about some of the challenges that come with Genius, I mean, I think the hardest thing is that it's a really great bill. Like in my opinion, I think they strike a lot of balances well. I think one of the challenges that they continues to I think, or one challenge is they don't really go far enough and provide enough clarity, especially around this yield question, right? And I think that is one of the concerns with Genius. And I think, if we get market structure and we get yield, and we get more clarity around these issues within, say, 5 years or a couple of years, right? Like later this Congress, right? It's probably not that concerning. But I mean, I think one of the challenges that comes with kind of just carving out and being like, hey, yield-bearing stables, we're just going to deal with that later. Or like, I mean, as we see in market structure where they go, hey, DeFi, that's really hard. We're just going to try and figure out how to do centralized exchanges, and we're just going to deal with DeFi later. So there's kicking the can. And on one hand, I think it's important because I think no rules is better than really bad regulation of DeFi or yield-bearing stables or things like that. But I think another challenge that comes with that is when you have a regulated category like a stablecoin, and then you're kind of like that, but you're not exactly that. In 10 years, if we don't get further clarity, someone's all of a sudden going to be like, "Whoa, like why don't you just look like that? That's the standard. When are you going to comply?" And so I think that can be a real challenge. That it's not a challenge enough. I'm certainly supportive of Genius, and I think moving forward, it's important to provide that clarity so that we can do things like have better data on capital flows and things like that. However, I do think that is one thing that I'm certainly watching is, okay, but how quickly does certainty on yield and some of these other things that we're kicking the can on go? And I think, quick plug, Confusion Capital has a policy effort researching this that we're working on. And I think, it's something that we should be thinking about because at some point, kicking the can is, I mean, as they said earlier in the macro podcast, it's like no decision is also a decision if left long enough. So
there is a way of reverse engineering the yield without resolving the yield question, which is if you can figure out uncollateralized lending, you can create, you can empower like institutions like Aave to in effect do this themselves, right? Because now, if you want the yield for your stablecoin, you just park it on Aave and get the equivalent of the yield. The problem at this point is that under collateralized lending really doesn't work, right? If you think about small business loans, right, where people need working capital, you can't, you're not going to go to Aave because Aave can say, well, give me $100 and I'll give you $60 back. So you're functionally speaking, you're in a worse place than you started, right? That's why they go to a bank. But if you're in a situation where, say, look, you can tokenize your receivables, you can tokenize inventory, or we're going to give you a line of credit that's not fully collateralized, but because we now have mechanisms to enforce these types of claims, then demand goes up, right? Which means that now you can potentially earn more yield from Aave. So you fix the supply-demand imbalance, then which drives more demand for stablecoins, because now people using them, especially in international countries, they say, well, I can use this to offset the debasement of my local currency, and I can also actually earn on top of it, right? And that's potentially a workaround, even without resolving the yield question, and that is actually really powerful for like the incumbent. That is really powerful for the incumbent stablecoin issuers because then they never have to rebate the yield, and there's no question of competition. Right, because I think the bear case for stablecoin issuers is like, well, it's not actually having the stablecoin is not a moat, having the distribution is, and if stablecoins are fungible in effect, right, it just becomes this ultra competitive game where you basically have to rebate the interest back to holders, right? But this is like one way around that, which again, ironically, like just increases dollar dominance alongside Bitcoin dominance, and those things actually become like, even though Bitcoin exists as supposed to exist as a separate system, the price appreciation of Bitcoin actually might become inexorably tied to U.S. dollar dominance abroad in the current way that in the current construct.
And I don't think you have to entirely hang it all on the Genius Act either. I mean, I can't believe I'm actually saying this, but the SEC last week had a roundtable called DeFi and the American Spirit, and they, are creating this sandbox and this conversation about that clarity. So I don't know that it's solely the responsibility of the Genius Act to do that.
Yes, I completely agree with that. So let's assume we're in the world where we have other major asset classes which are tokenized and they provide yield. I mean, really, the stable coin is just a very small piece of overall. You can essentially bundle these assets into and get the yield, reverse engineering the yield, as you said. So I think that's just like the tip of the iceberg. I think the bigger opportunity is to be able to access other type of assets that can provide the yield.
You could also envision this an end game where, okay, so right now the stablecoin market's dominated by Tether and Circle, and let's just say that continues and it amounts to best since estimations of 5 trillion. There's no chance, like it's already basically a monopoly, and what's very easy for a government that's suffering from all these problems we talked about, who also just talked about wanting to cut interest on reserves, to pick off, oh, there's 5 trillion of captive capital here that 2 companies are profiting exorbitantly, and we know exactly where those funds sit. Well, here's a new rule: we don't pay interest to stablecoin providers, and you have to, or we take them over, or there's these almost like, while we're not endorsing a CBDC, you sort of set up the risk vectors of more centralization, given it's easier to track the flows, it's easier to put, if you have cash in your pocket, it's hard for the government to get without force. Like, it's a lot easier for them to control this in ways. So there's also these other risks to think about in terms of, which is kind of a Bitcoin bull case.
Maybe I'm thinking about this wrong, but is it kind of just like a backwards way of just like supporting the treasury market? Because, all right, $5 trillion in stable coins, you could think a lot of that is coming from cash in people's pockets, which aren't in the treasury markets right now. So it's just kind of like going to support buying T-bills and maybe longer dated stuff.
Especially for those foreign buyers who previously did not have access to US dollars, right? They now go to stablecoins. The stablecoins then go to the treasury markets, right? And now Tether is the 7th largest holder of treasuries, officially. And unofficially, who knows?
There's a few points. One, I'm not sure that the market is going to be dominated necessarily by Circle and Tether, because this legislation it's ready to explode with new players coming in. So it'll be interesting to see how that plays out over like the next year, 2 years. We're talking about the interaction of the dollar and Bitcoin, and Bitbonds is an interesting wild card that could have a lot of different effects, I think, on demand for the dollar and demand for Bitcoin that can play into this. Forgive me for anybody who was in the last breakout next door, that I mentioned this in there. And another wild card is that some players who are starting to mint stable coins that are outside, that may not be backed by anything. There's a criminal group in Cambodia called the Huoyne group, I think it's called, that their darknet market basically ran on Tether, but as Tether has come more into line with U.S. regulations and abiding by their sanctions, they've created their own stablecoin that, as far as I understand, is not backed by anything. I don't know too much about it, but they're obviously not. They're created specifically so that it's not regulated and they can operate without being frozen. So those are some interesting twists to this. And that one other thing that's really interesting too is the ability that you guys were just talking about, the demand shifting to retail for dollars when they have access to dollars in markets and places that never could access. Where if anybody's traveled much in different parts of the world, like you'll get a premium for bringing in crisp $100 bills when US $100 bills when you're exchanging currency, and you might not be able to exchange it at all if your bills are crinkled or not crisp. Now those dollars can be the demand for dollars in the corners of the world where dollars weren't available will have access. If you have an internet connection and something to trade for dollars, you'll be able to get them. And that puts a really interesting tool of economic warfare in the hands of the U.S. government for regulated stablecoins that can be seized, freezed, and destroyed. So they can have, the U.S. government's going to be able to have some different types of pressure to exert on other governments either by seizing those or when a government in whatever country says, hey, we identified a bad guy, can you please freeze their, help us to freeze their funds? And the U.S. government might use that as leverage to do other things as well.
I actually wanted to go from your statements there I want to ask a question of Larry specifically for this, because this is about the macroecon outlook. So the US had the free banking era in which many banks could issue their own currency. And some of those banks were much like the group you mentioned. Perhaps when they issued those currencies, they were perhaps not fully backed, not good actors, wildcat banks. And I know, Larry, you've written a lot about that distinction, and I think also in the area of stablecoins specifically. So when you think about things like the Genius Act and the policies that are being passed to bring some sort of regularity to the stablecoins, what are your thoughts on how this plays out within the US banking system, within the macroeconomic system, and within the debt markets, if that doesn't spoil your talk tomorrow?
No, I wasn't going to talk about stablecoins tomorrow. The US free banking era was kind of misnamed because there was a lot of state-level regulation. And if you ask, was it a success, the answer differs from state to state. But the states that had the most problem with fraud and with bank failures were the states that regulated the banks most heavily, because the typical regulation was to force the bank to hold state debt, which was a bad asset, and to overload on state debt. If you look at banking systems around the world where they didn't have those kind of restrictions that weakened banks, if you look at the free banking system in Scotland, which is my first book, or in Canada, or Sweden, or Switzerland, they all worked very well with minimal regulation, no portfolio regulation, just some trivial things like you couldn't issue bills under £1, things like that. So I think stablecoins can provide a measure of self-regulation. They are kind of like unregulated banks. But to me, that's a good thing. That means they compete more. There are fewer barriers to entry. And what I fear from the Genius Act is barriers to entry that will restrict competition and limit yields and make them less available to people by raising all kinds of regulatory barriers. So Tether has done pretty well without, regulatory clarity. And although they've done some dodgy things, as far as we can tell, they have managed to scrape through. Whereas USDC, who are the good guys, actually went insolvent because they had too much money in Silicon Valley Bank. And they went insolvent the weekend that Silicon Valley Bank failed, and they were bailed out by the FDIC, who decided to rescue the uninsured depositors. That's not the sort of thing we want to see.
I mean, to be fair, they did put their money in Silicon Valley Bank because the FDIC insurance was there. And they did have enough to mostly cover
$250,000 per account.
Well, it was self-reinforcing because it was also very difficult for like a crypto-adjacent entity to get access to banking under the Gensler era. And so you had to, right? And that was I think in retrospect, like when they investigate what happened
among
with
the
Signature.
three banks that were open to them. That's true.
Yeah. But I think it's, I think JP Morgan and a banking consortium, they're already talking about issuing their own stablecoin. PayPal has its own stablecoin already, and it's just a question of how far they push distribution, right? And the major fintech apps of Revolut and Robinhood, it could just be a matter of time before they roll out their own version of stablecoin. Because I don't think we've answered the question. It's like, is the value with the issuer or is the stablecoin fungible and the value is held by the distribution? Because I think like the way that the public equity markets have priced it, right, is before IPO, people were looking at Circle and saying, well, Coinbase owns most of the economics of this, so the value is in the distribution. But in a free-floated market, Circle is now en route to flipping Coinbase's market cap. So apparently the market is saying actually the value is with the issuer. I don't think that question's been answered yet.
I think what Circle does and what Tether does is very easy to replicate, and lots of firms are piling in now. But it takes some, track record to attract users.
Yeah, I'm curious. I wanted to bring that up. I'm glad you brought that point up, Eric. Just the fact that Bank of America, JP Morgan, they're both at already, well, Bank of America did it first and then JP Morgan after the Genius Act, but how will that play into the stablecoin landscape where we might start to see a flock of flow of funds to these bank issued stablecoins, and not actually trigger more innovation as you guys were arguing before. I'm curious to tie that point to the previous point of like the smaller community banks. Is this likely to result in like consolidation for those banks that don't have the means to, or the distribution to play into this stablecoin endgame that all these players are aligning to partake in? Like, will that result in bearing antitrust? A consolidation of the smaller players just in an attempt to survive and to partake into this?
I mean, I think it's gonna be dependent on what the use case for those stablecoins are. Is it going to be part of a payment rail that makes certain things better, or because let's kind of just audit, like, we've had protocols and teams come up and try to launch stablecoins, and inevitably the issue they run into is they don't have distribution. There's no really a good ability to grow circulating, and then you have it's expensive because if you do a stablecoin on chain right now, you have to like bribe, do bribes on Curve, or basically get people to support the peg of the pool, and that makes it very difficult to do, right? And there's just inherent stickiness with Tether because just can cut to the chase, like the runaway use for it, like the product that has found product market fit in crypto right now is the perpetuals contract, which is basically just a form of gambling, right? And Tether is powerful and has been very sticky because it's the dominant pair across most of the centralized exchanges. And so if you can't get someone to adopt a stablecoin for a specific use case, then you're gonna suffer, right? And so I think like the value proposition for these banks doing their stablecoins is like, well, they own payment rails, and they have all this infrastructure that they can use the stablecoin for, and it would net make things better. But it's you can't just have a stablecoin just to have it. Like, it has to solve a real problem. And I think like, I don't know if anybody saw the really long back and forth of the founder of AirWallets, basically with most of the VC community on the need for stablecoins, right? Jack is saying like, well, like, I don't know what problems the stablecoins solve. I don't actually think, like, obviously he has some bias, but I don't actually think his claims are totally unfounded because these are questions like, if you're a new issuer, the model itself is very easy to replicate. But if you're thinking about like, well, how do I displace Tether? You basically have to answer the questions like, well, like, how do I get Binance to add me to the trading pair? How do I get adoption in whatever ecosystem that I think is going to drive demand for stablecoins, right? Like, if anyone went through the S1 for Circle, right? Circle actually to even get on Binance, they paid Binance $60 million upfront to just hold $1 billion of USDC. It literally is like, here is some money, please hold my stablecoin, because it's just they tried forever and they just could not get traction and get that added as a trading pair, get USDC added as a trading pair, right? It was only like that week when USDC depegged that demand for USDC on Binance went up because everybody wanted to play the repeg.
So we're about to run out of time. We have run out of time. I was going to give everyone else like a minute to summarize their last thoughts. Do we have time to do that? Just give everyone time. All right. So last minute summary of your thoughts.
You start.
I think I'm interested with the Genius Act and with stablecoins to see the impact on other economies, right? Because I think everyone focuses on the benefit in terms of stable currencies and all that jazz. I think people forget that the macroeconomy is connected. And I want to see what happens in terms of, let's say, loans, the ability to get loans and what that does to economic growth and economic development and capital flows.
I'm interested. We talked about U.S. dollar dominance with stablecoins. So I think one of the open questions for me is do the other countries that are looking at this, I got to remember to do that are looking at this say, well, if the U.S. is making their dollar more fluid and easy to use, and that's increasing demand and adoption, do I also create my own stablecoin in my own native currency, and what are the added on impacts to that, right? And that's not going to work for everybody, but for Europe, India, and maybe parts of Asia, like there could be some demand, right? And that solves actually a very real problem, because for regular people, it's actually not that easy to access currencies in foreign countries at the stated rates. So I think these are like interesting questions about the second, third order impacts of like stablecoin usage and adoption.
Yeah, I think high level, I fade the use case for stablecoins domestically in the US, but I think it's going to absolutely explode in the rest of the world. I had a fascinating conversation a couple weeks ago on my podcast Forward Guidance, where I interviewed Robert Bench, who led Project Hamilton, which was the CBDC research at the Boston Fed, which was the main consultation for CBDCs at the Fed. And he was also led the regulatory framework for Circle when he worked at Circle there. And he believes that in about 8 to 10 years, there's only going to be about 3 to 4 currencies, and US dollar reserve dominance is going to increase very substantially because of stable coins. And he sees, that just increasing very significantly. And that was something that I've been still thinking about since, and is definitely like a guiding thesis for how I'm thinking about things now.
I'm just focused on how stablecoins can increase demand for the next Trump meme coin.
Well, it'll be denominated.
Exactly. Yeah. So how we can tap the piggy bank more from the executive branch.
Thank you, everyone. Michael, any last minute announcements? No.